following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are having a fun and exciting and very profitable trading week. I know our schedule is a little bit off this week, but I blame that squarely on Don. No, actually, that was... He'll take the heat. No, actually, I've been traveling a little bit, and Don's actually been quite busy himself for a semi-retired fellow. So both of our schedules have not been able to overlap until today. So we're getting the show to you a little bit late this week, but nonetheless for quality content. And of course, my name is Mark Longo, and I will be your host for this Volatility Review Extraordinaire. And I am joined, as always, by my partner in crime, the yin to my yang, Don Schlesinger from Volex. Don, how are you doing this fine Tuesday afternoon?
Just fine, Mark. Happy to be here as always in this holiday season, and looking forward to today's show.
That's true. We do have a holiday shortened week, don't we?
Right.
I've been on vacation, so I don't even remember what the new holidays coming up are. It's all been one big holiday to me for the last week or so. But yeah, so with that, I think we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is where we discuss some of the interesting happenings from our extended period of both last week and into early this week. And Don, I know before we toss it over to our volatility pit reporter there, Mr. Sebastian, I know you have some interesting developments to discuss in the Euro vol today.
Yes, it's actually something that demonstrates the volatility of volatility that we've been talking about, especially in the shorter dated product. We're recording this program on Monday. We'll probably get it up on the site by Tuesday the 19th, but here's something interesting that has taken place. The May 1 vol, which is to say the 1 month May realized volatility contract in the Euro that we have up and trading on the CME, was 5 days into its expiration period. In other words, we call that the realized volatility period, where we actually start calculating and logging the returns day by day. And for the first week or 5 trading days of this 20-day period for May, we actually recorded a very low partial volatility, which is to say 5 days out of the 20, and it was standing at 5.19 to start the day. And today, as some listeners may realize, the euro had a very, very big move, actually down 1 3/4%. Well, if you annualize such a figure, because that's a daily return, and we know square root of 252 is approximately 16, so if you take this very big 1 3/4% move and you multiply by 16, you get 28 as the data point for today. In other words, the 6th day of trading, and now a 28 to get added into the 5 days worth of 5.19. And don't you know that with just this one data point, We now are looking at a partial volatility that will include today for the 6 days of 12.37. I've roughly figured it out. It may be off by a couple of decimal points, but the point is, here the value has risen dramatically due to that volatility of just the 1 day's data. We sometimes get people say to us, gee, if you're going to be logging the points day by day and, they carry their weight, then, 1 day's move can't really have much of an effect when you've got a lot of other data points. Well, here you see how dramatic that effect can be, and that holds true even if it's on the very last day of the contract and you get a very big move. You can still have, from a percentage point of view, a considerable move in the value of the underlying contract. So today was such an example.
Yeah, I would think actually that it would be the opposite, that you would be concerned that 1 day's aberrant movement in the underlying could send you off the cliff in terms of volatility, as opposed to worrying that you couldn't get much bang for your buck from the daily fluctuations with this contract. Well, if anything goes to prove that, then today's activity goes to prove that these realized vol contracts do indeed register some dramatic moves based on what's going on intraday.
Yes, exactly. And, when we've been out talking to people and explaining the product and explaining the different durations, I bring it up simply because that is sometimes, I won't say an objection, but let's say the potential for concern of some end users. They see the fact that these data points get logged into the formula, and we have heard some comments along the lines of, oh, well, gee, when you get to the last few days of the contract, I guess, it's kind of over. No one's going to want to trade that because we won't have much movement, and we have to kind of just gently correct them and show them the math and explain that, hey, this thing can move right up until the last day. All it takes is a good, shock one way or another to the underlying to get in one big volatility point there, and because of the squaring feature, it can still have quite an effect on the overall averaging process.
Well, let this episode then put to rest any further objections regarding this product, that it can indeed move quite a bit off the intraday activity in the underlying.
Absolutely.
And with that, we will toss it over to our own volatility pit reporter, Mr. Mark Sebastian from OptionPit.com, to get a quick overview on what's been happening in the other volatility products over the past week and a half or so.
If anything, we can't say that there wasn't some action in volatility last week.
No, it was a good one.
It just so happened there was action in one direction. It was downward. Sell, 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 sell. Interestingly, this is kind of one of the interesting things. One of the things I like to watch when I'm looking at volatility is what's happening to options on things like VIX. While S&P option volatility is falling, VIX option volatility was actually increasing for most of the week. And so we had this weird thing which makes sense actually, where we saw VIX itself in general volatility and market volatility fall. And then as people begin to basically start to get a little shaky, a little nervous in their boots, they start coming for the options, coming for the futures. Although one interesting thing to note is how crazy Contango got. And just to let you guys know, we are recording this on a Monday, so I'm going to kind of tell you what I prophesized and what actually happened today. And we'll roll into the week ahead at that point. When you've got a May VIX future, this is one of the issues I do have with the VIX, where you've got a VIX trading at 16, or actually 15. Where did we close on Friday, Mark? 15.
Oh, 15 something. Let me look it up.
Yeah, 1530. 1532.
1530, yeah.
Yeah, 1532. And then you've got a May VIX future trading at almost 20. Okay? When you get that first pop in volatility from 15 to 16, 16 to 17, the futures themselves have almost zero participation in that movement. It's not until we get kind of that, it's almost like imagine you're pulling a coil Okay, and you notice if you pull a coil back and then let it go, at first that coil has to kind of coil together. Then it'll kind of move forward once you let go of that coil.
Would that coil even be a slinky?
It could be a slinky, but yeah, imagine you've got a slinky. Imagine you've got a slinky on your desk, and you coil it apart, and then you let it go. Before it moves forward, okay, the coil has to catch up to like the bulk of it, and that's kind of you have to look out for when you're seeing those type of events, and that's kind of the volatility we can review.
And thank you for that, Mark. And with that, we will close out the volatility review and roll right into the strategy session.
The strategy session.
And welcome to the strategy session. This is the section of the show where Don and I pick apart some interesting volatility trading technique or strategy and discuss it at length. And given the fact that I've been out for most of the past week or so, I think this one's going to be mostly Don, but I will jump in where available. And I remember, Don, from our previous discussion, we talked a lot about different aspects of vol and some of the pitfalls and perils of buying cheap volatility and the overall concept of cheap volatility. And that leads naturally to a discussion of some of the different perspectives and viewpoints of volatility and also the different ways we see volatility displayed in the marketplace. And I know last week we just didn't have time to get to the topic of Contango, which is obviously a big one on the minds of volatility traders today. If you look at the VIX futures, for example, this has been a very prominent example of Contango recently, and that's been featured into and factored into all of the trading strategies we're seeing people employing both in the VIX futures and in the options that derive off of those futures. But I know a lot of our listeners run the gamut from the very experienced to the very basic. So I guess we should start off with, for the very basic listeners, with a brief overview of Contango, Don.
Well, I wanted to point out something that actually follows up from the discussion that we had about the risk premium of implied volatility over realized volatility and how normally we see options trading at levels of implied that very often from a historical basis go on to be about anywhere from 3, 4, 5 points higher than the actual volatility displayed by the underlying. There's an analogous type of situation where we have the VIX index, which is, if you will, the underlying for VIX, and which is a composite of the implied volatility of a wide array of the options that trade on the various VIX products, let's say the S&P 500 that listeners are familiar with. And then, of course, you have the futures, which are not exactly the cash, as everybody knows, and the futures, therefore, have as their underlying the VIX index. And the point that I'd like to make is that since VIX is continually settling to that forward-looking 30-day volatility, the VIX is perpetually settling to implied volatility. So you don't have that kind of divergence, if you will, between the notion of trying to trade option straddles at implied and then capturing realized by delta neutral hedging. What is a futures trader to do? Where is his premium? Where is his risk premium? If I sell a VIX futures contract, am I not entitled to that same premium that options sellers command for the open-ended risk that they're taking? Well, the answer is yes, I am. But it has to manifest itself somewhere because the underlying index is implied volatility itself. So what we find is that, normally speaking, there's yet this next level of risk premium, which is that the VIX futures tend to trade at some kind of a premium of a couple of points over the actual cash VIX index for reasons that are similar to the argument that we made with options traders who, if they take a short position, command that extra premium over what eventually is realized. So what happens is when you take a look farther out, as the VIX futures are reaching their expiration and they are eventually converging to the cash price, kind of like coming in, if you will, you look farther out and you look at the next futures, and now you see that premium again. So people are constantly looking forward, and they're seeing somewhat higher levels of volatility in the VIX futures, and this is the concept in all of commodities of what we call Contango, where the farther out or deferred contracts are trading at prices that are somewhat higher than the current levels. But the point that I'd like to make is kind of twofold, and it'll lead into the next idea, and that is people shouldn't look at these values and necessarily assume that reflected in those higher levels is some sort of a prediction or a forecast of higher volatility going into the future and conclude that there's this kind of term structure of volatility such that the farther out we go, the higher volatility is going to be. I think that's an erroneous conclusion, but one that's very easy to make when you just stare at these VIX futures prices and you see that the farther out you go, the higher the levels are, but you need to understand why it is that way, and that it isn't simply the naive concept that, gee, the farther out we go, the higher volatility is going to be in the long run. So that was the point that I wanted to make, and then it kind of segues into the next kind of small topic, which is, well then, what is the term structure of volatility, or what should I look for? And I think what's important to understand is that when you look to the long term in volatility, what you're really looking towards is mean reversion. And therefore, we all understand that volatility for any given asset has some mean or average value. Let's pick a number and say 20. Well, if we're in an environment today where for one reason or another volatility is at, let us say, 40%, well then it's very, very unlikely that that 40% is sustainable over a 1-year period of time. And therefore, if I look to the future and I go out into the deferred months with a 40 regime right now, you better believe that I'm going to probably see lower values for volatility, because people are thinking, well, gee, I could see 40 on the S&P for 1 month, but I'm not going to see it for 12 months. It isn't going to sustain at that level. It's going to revert to the mean. So I would fully expect, if the average is 20 and we're trading at 40, that if I go out 6 months, 9 months, 1 year, I'm going to see levels of volatility that would be considerably lower than the 40 that I'm demonstrating today. And finally, if it were the other way around and I were sitting at 10 or 12 volatility, I might think, gee, that's awfully low compared to the historical level. And so as I would go out further, now it would be perfectly natural for me to see higher volatilities, as I would assume that eventually, given enough time, volatility is going to revert to the mean, which in this case would be up at 20 and therefore higher. So I think the takeaway from all of this is that listeners should understand that, yes, there's a term structure of volatility, but no, it isn't just naively, gee, the farther out we go, the higher the volatility should be. That's much too simplistic, and hopefully the examples that I've given demonstrate that it really isn't always the case.
Well, we aim to correct the simplistic and the naive on this show, Don. That should be our subtitle, actually. Volatility Views, correcting the naive and the simplistic since 2011. But, yeah, Don, that was an interesting example. And, you know, of course, whenever we're discussing different aspects of volatility and volatility distributions, the next topic that comes to mind, I don't know, especially in the options parlance for a lot of premium sellers, is the concept of the volatility cone. I know for premium sellers, they use this technique quite a bit to try to get a gauge of what they feel the as a useful trading signal for their volatility. You know, they can look at this and they can use the volatility cone to get a basic distribution of the historical volatility of an option. So then they could say, well, here's a typical mean, here's of the implied volatility, here's the typical distribution of this historical volatility, and if the current volatility is, let's say, above that outer edge of that cone, then you can feel safe selling that premium and vice versa. Whereas if you're far below the lower edge of that cone, then you can feel safe buying volatility. I know that's heresy to you, Don, so I will keep that example to a minimum. We shan't discuss the buying of volatility.
Certainly feel free to go ahead, because your description is exactly correct. And if one were to be inclined to buy volatility, then quite clearly exactly what you described would be the time to do it, when you're at levels that historically show that from a probability point of view, there may be a very good chance that actual volatility would be increasing. My dear friend and the CEO of the Volatility Exchange, Bob Kraus, and I actually wrote some number of years ago, I think it might have been in the mid-1990s, 95 or 96, an article for an in-house newsletter that we created at Morgan Stanley, and I think it was actually reprinted a year later in Futures Magazine. And we titled it "Volatility Cones Come in Many Flavors." And we went on to discuss...
You two are so clever.
We went on to discuss the various constructions of these cones and how they can be made. So let me see if I can briefly describe for our listeners what such a cone would look like. I can't show it to you on the radio, but you can envision it. And then also try to describe, as Mark began to do, the usefulness and why some people look to this, especially when they're trading options.
And if listeners are interested, it was republished in the April 15th, 1996 edition of Futures Magazine. So you can.
Oh, that's great. You got the ready references.
My Google skills are matched by none, sir. But
so there you go. Exactly. Almost a birthday. Almost 15 years to the day.
Wow.
So in any event, here's the idea. Suppose you gather a good deal of historical data on the volatility of a given underlying, such as the S&P 500, and you go back several years, and so you gather the volatility levels on a 1 month basis, 2 months, 3 months, all the way out to, let us say, 1 year. And on a horizontal axis, you print 12 months ago, like minus 12, minus 11, minus 10, going from left to right, until you get to the 1 month volatility variety off to the right. And now what you do is you examine all of your data, and you arrange it in percentiles, so that up above you might call it the 90th percentile, and then drop down to the 70th, the 50th, which would be a median type of number, 30th, 10th, etc. And you actually see for each duration, in other words, a 12-month volatility, a 10-month volatility, a 2-month volatility, what those extremes were. So you might find that over the short term of one single month, you could have had 1 month volatility over that historical period that you studied as high as, let us say 50% or so, and as low as single digits, 4, 5, 6%. What you find, though, is that extreme cannot be matched over the longer durations of time. So when you get out to 6 months or 9 months or 12 months and you study the range or the variability, it becomes somewhat tighter. And you'd find that, no, you never had 50% volatility for a whole year. You never had 4 or 5% volatility for a whole year. Those numbers are closer. Maybe the upper range was 30 or 35. Maybe the lower range was 15 or 13 or something like that. So if you start to plot these lines, what happens is they're kind of tight on the left-hand side, and then they fan out and they open up much the way an ice cream cone does from its tip at the bottom to the widest part at the top, where hopefully we get that big scoop of ice cream. And so when you plot these, we call them volatility cones, and what they do is allow us to look at any time period that might match, for example, the duration of options that we're contemplating trading, and get a very good handle on, from a probability point of view, what the extremes have been, and therefore what the likelihood would be going forward if the past is prologue to what we might expect from our options trade. So given the examples that I just talked about, suppose you were contemplating a 3-month option that you wanted to buy or sell. And suppose the implied volatility for that particular option was at about 15%. You might consult your volatility cone, and it might tell you that for a 3-month period, 70% of the time, realized volatility went on to be higher than 15%. Well, that's a good example, Mark, of what you were just talking about. If you're inclined to buy volatility, well, now maybe this is a good time to do it. I've kind of got the odds in my favor. I'm buying 15, and my study shows me that 75% of the time, 3-month volatility in this particular instrument goes on to be higher than 15.
Exactly. Or in your parlance, you can also say that instead of buying, you can choose not to sell the option at that exact time.
Well, that's the case. And then, of course, I wouldn't be doing myself a favor if I didn't give the sell side version of it. And that, of course, is the flip side. So now you go to contemplate trading a 3-month option, but you find that it's at 33% volatility. And you take a look at that 33 implied and you say, gee, that seems a little rich to me. Let me consult the cones. And you go to these bandwidths or these percentiles, and you look at your 3-month, and I'm just making this up. I don't have the data in front of me, but you say, wow, 80% of the time, 3-month volatility has been less than 33. You don't see too many examples where this index displays 33% volatility or higher over a full quarter or a 3-month period. This would be a good time to sell such a level of volatility. So again, you get no guarantees. It's not always the most perfect crystal ball, but what you're trying to do is use the volatility cones as a tool that allows you to assess the volatility levels and what they usually are, and therefore allow that to be a guide as you contemplate buying or selling the current levels that you're looking at. And so what we plan to do, it's in the works, is that we'd like to put up on our website, which listeners who have heard previous shows know is simply Volx, VOLX.US, has a great wealth of information, but we're constantly trying to expand it and enhance what we offer to our traders and to our listeners. And so we'd like to not only put up the article and the essence of what I've just described on the website, which should be there shortly, but we are working on an application that will actually allow people to create volatility cones on the various underlying assets that whose volatility we're tracking. And so hopefully it won't be too long before you'll be able to consult the Volx.us website and actually have these types of volatility cones to help you in your options trading and in your vol contract trading and in your volatility trading in general.
Don, you read my mind. I was just about to ask you, A, if this article is available on the good old Volx.us website, and then secondly, do you have a tool of some sort that allows people to generate volatility cones? And so you read my mind, sir, once again.
Well, hopefully the answer is yes to both, not today, but in the very, very near future.
It's getting a little frightening, sir, how you read my mind. I think we've been doing the show together for too long now.
There you go.
And we'll also have to, when you get that article up, maybe we can reprint it for you as well on the Options Insider to get it out to some of our audience and get them into the concept of volatility cones. It might be useful actually for the edification of our audience too, to maybe we can include a few samples of volatility cones as a visual aid in the show notes for this program, so people can take a look at them and say, oh, that is exactly what they're talking about. That is that cone shape with indeed that delicious ice cream topping at the end, where I'm looking to sell or not sell my option premium this month. Don, that was some interesting stuff on term structure and, of course, the delicious, delicious flavors of volatility cones. And with that, we're going to close out the old strategy session and roll right into the crystal ball segment.
And now we take a look at the crystal ball.
And here we are in the old crystal ball segment, where we get to pontificate at length about what is going to happen in the coming week in terms of volatility. And before I toss it to our old greasy meatball himself, Mr. Sebastian, Don, do you have any forward-looking outlook about what's going to happen here with the Eurovol over the coming week?
Well, it's going to be very interesting to see on the heels of today's movement, and of course the market in general with various events that are going on was extremely volatile today as well. And so people have seen in these first two vol contracts that there was in both the March and April contracts some sort of a sell-off or decay, if you will, from the initial values. We talked about 32% and 30% declines. Well, let's see if may not turn out to be a little bit different, and if this isn't the start of what might be a slightly more volatile period, both for the markets in general and for this particular euro contract that is now trading the third 1-month product and also still in the realized volatility of the first 3-month product, which is the June 3-month volatility realized contract. So be interesting to see if we don't have a little bit of a turnaround to the upside in the days and weeks ahead.
And Don, before we go, I suppose we should at least discuss the elephant in the room, which is, of course, the ridiculous movements that have been happening in the old VIX cash over the past week. And before we toss it to Mr. Sebastian, I know I've gone on the record on a number of shows stating in the past my overall lack of use of the VIX cash for as any sort of real volatility measure. And I think the fluctuations over the past few days, where it got down to the 15 range and now it's up 17% today, just show you how little utility you can generate from that index on a given basis, and how many other elements can be boiled into that VIX cash number aside from just what you derive from the futures and from the implied volatility of the SPX. There are other things like skew and everything else you have to take into account, as well as paper flow. And so we see it whenever. I just love seeing the headlines of, VIX up 30%, VIX down 20%. The media loves to grab onto it, but it's not exactly our cup of tea. And Don, what's your feelings on the way the VIX has been bouncing around over the past couple of days?
Well, I mean, you've hit the nail on the head, and again, I've really sworn off of trying to use our Volatility Views program as a VIX bashing instrument. I stated on the very first program that we had that I think that it has served a function. I respect people who not only trade it but who value the level as a barometer or an indicator. But you've pointed out what some of the shortcomings are, and there's the schizophrenia or the hysterics that go with kind of overstating positions when events take place, and therefore it simply is reflecting that, and therefore you get these bounces and these movements that appear to be all over the place as options premiums trade 1 minute at one level and 2 minutes later an X. I'm not sure that it's terribly valuable for any kind of long-term getting a handle on where volatility is going. We like to think that there are perhaps more scientific ways, if that's the right way to put it, of forecasting volatility. And again, listeners who've had an opportunity to go to the volex.us website and take a look at some of the modeling by Robert Engel and the Volatility Institute in their forward-looking predictions of 1, 3, and 12-month volatility, as well as the volatility settlement prices of the contracts that we're trading, might compare those values to some of the implieds and VIX-like levels that they're seeing, and just kind of take a look at how they stack up one against the other, and I'll let listeners draw their own conclusions when they do that.
And now we can toss it over to our good friend, the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com, to get his pit report for the coming week in terms of what we're looking at in VIX and SPX skew and his very own customized CBOP index. Mr. Sebastian, take it away.
Mark, I'm going to go out on a limb. All right, I'm going to make a bold prediction.
Please do so, sir.
All right.
That's why we pay you the big bucks.
Standard & Poor's is going to downgrade U.S. debt on Monday.
Where did you hear such crazy things?
It's just something that it's a guess that I'm making. Okay.
We need to up your pay for these great prognostications.
Oh, really? You could give me 1,000% increase in my pay, but 0 times 1,000 is still 0.
More slinkies for you, sir. All the slinkies you can handle.
There you go. We saw that exact, what I was just kind of discussing with that coiling, we actually saw on the VIX product almost exactly. Now, we saw a pop in volatility in SPX May options. We saw a pop in volatility of the VIX options, but the VIX futures themselves, the underlying equivalent of the VIX options, saw really, I want to say May, when we were up at one point almost $4 in the VIX, May was up about $1, and June was up about 60 cents. Okay, so we missed in the VIX futures a huge portion of that move. The options, on the other hand, did have some nice, and that's one of the nice things you could do is that there's if you're playing the VIX futures, one thing you can do is when we get kind of this low, kind of weird, overly contangoed environment. Okay, you can buy options, and they're actually going to do a little better job than the futures initially. And that's kind of what we saw today. So that was kind of now looking at the week ahead, now that we've had this downgrade, it's a 4-day week, okay? I feel like they've already priced out Easter. So
yeah, I think the holiday is already out, I would imagine.
Yeah. So don't be sitting here thinking you're going to get a long weekend. Okay? Don't be sitting here thinking you're going to get any weekend.
Hit all bids is what you're saying.
Yes. Hit the bid. Sell the preem and live the dream. You know what I'm looking forward to in a couple of weeks when I just hear sell in May and go away all the time? Sell in May, go away. Sell in May, go away. Sell in May, go away. You know, I feel like that's the mantra of CNBC. Is it going to be sell in May, go away? And I'm looking forward to that cycle of ridiculously cliche, hyperbolic, hey, to put things in the same hyperbole they would use on CNBC, nothing makes me more annoyed than hearing them talk about the sell in May and go away. So
predicting hyperbole on CNBC is kind of like predicting rain in Seattle. I think it's just one of those foregone conclusions,
Predicting baritone in Longo's voice.
Indeed, sir. The deep, deep, rich baritones of my voice. And with that sultry conclusion, we'll close out the Crystal Ball segment and close out this episode of Volatility Views. And Mr. Sebastian, if our listeners want to hear more about your pit reporting or your CBOP or any of that other fun stuff, where should they go?
OptionPit.com. That is the home for volatility-based trading. So, in the retail world.
I want to thank my co-host, my partner in crime, Don Schlesinger from Volex. And Don, aside from the volatility cones and the volatility tools going up on the volex.us website. Is there anything else our listeners could look forward to in the coming week in terms of what's going on over at volex.us?
Well, we continually try to update all of our materials, keep everything current, and Bob and I and the crew who maintain the website are always on the lookout for interesting articles, scholarly papers to post to the Volatility Library. There's a very wide array of interesting topics there that are updated every couple of days. So listeners should be on the lookout, check back frequently. We won't let the website get stale. You're constantly going to be seeing new things. I was getting ahead of myself. I'd like to mention to all of the listeners at this holiday time a very happy, healthy Passover, a joyous Easter, and have a wonderful holiday week.
Indeed, and of course, our listeners can also come to theoptionsinsider.com and post their questions for Don and myself in the Volatility Views forum, and maybe next week we'll have an all-listener question show where we can sit down and parse some of your interesting and pithy comments and questions for the show. Of course, you can also leave us a voicemail at the Options Insider Radio Network voicemail line. That number is 312-544-9356. If your question is interesting, we may just play it on the air and immortalize you for all of your friends and neighbors, so make sure it's a good one. And with that, we're going to close out this episode of Volatility Views, and we'll see you next week.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.